Right now, gold is trading in the low 4,000s, sitting below a number that one of the largest banks in the world has publicly called its worst case scenario. Not its target, its floor. The number below which that bank does not expect gold to fall, even in a bad outcome, and yet that is exactly where the price sits today. At the same time, 5 separate major banks, JPMorgan, Bank of America, Wells Fargo, Société Générale, and others, all currently have official price targets sitting at $6,000 an ounce or higher. That is not a fringe number from someone selling coins online. That is the published position of institutions that manage trillions of dollars, sitting roughly 45% above where the price trades today. I want to walk you through exactly why that gap exists, why it has actually widened even as some of these same banks trimmed their near-term numbers, and what it means for anyone holding gold or thinking about it. Stay with me, because by the end of this, a 45% gap between where a major bank says gold is heading and where it trades today is going to make a lot more sense than it does right now. Here is the twist, and I am giving it to you immediately instead of making you wait, because it changes how you should hear everything else in this video. Several of these banks did trim their near-term numbers earlier this year. Goldman Sachs cut its year-end target. UBS cut its target. Deutsche Bank cut its target. If you only read those headlines, you would assume the institutional case for gold was weakening. It was not. Even after every one of those cuts, every single one of those banks kept a price target well above where gold trades today. And several of them, JPMorgan among them, actually raised their longer-term target during the same stretch that gold was falling from its January record. The cuts were not the banks losing confidence in gold. They were the banks adjusting the timing of when they expect the move to happen, while keeping the size of the move itself fully intact. That distinction between banks doubting the destination and banks simply debating the calendar is the entire story almost nobody explains clearly. Before I go further, I want to know who is with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly whether you owned any gold in January, near the all-time record high, and if so, how you have felt watching the price pull back since then. I read these, and I promise you the answers under a video like this always reveal how differently this exact pullback feels depending on when someone actually bought. Let me lay out the actual numbers, because they are more dramatic laid side by side than any single headline captures. Gold set an all-time record just under $5,600 an ounce on January 29th of this year. Since then, it has pulled back meaningfully, trading recently in the low 4,000s, a real painful correction for anyone who bought near that peak. Against that backdrop, here is where the major banks currently stand. JPMorgan raised its target in February from just over $5,000 to $6,300. By the end of this year, one of the largest single upward revisions from any major bank all year. Bank of America has a 12-month target of $6,000, with its analysts specifically flagging Fed leadership uncertainty, structural fiscal deficits, and historically low investor allocations to gold as underappreciated risks pointing higher. Wells Fargo lifted its own year-end target to a range of $6,100 to $6,300, up from a prior range closer to $4,500. Société Générale raised its target to $6,000, up from a previous $5,000 call, explicitly noting that even this new higher number might prove conservative. And JPMorgan's own stated bear case floor, the level it does not expect gold to fall below, even in a disappointing scenario, sits at approximately $4,340, a number the actual price has recently traded beneath. If you are finding this useful already, take a moment to like this video and subscribe, because the next part explains exactly why banks with access to more data than any of us keep pointing so far above where the price sits today. And it is not a mystery once you see the mechanism underneath it. Here is the mechanism, And it comes down to the difference between two forces that move gold on completely different timelines. The first force is what I would call the mood, the daily and weekly price action, driven by traders reacting to interest rate expectations, economic data, and short-term positioning. That mood soured for a real stretch this year, as strong labor market data earlier in the year and a hawkish shift in Fed expectations made gold, which pays no interest, temporarily less attractive relative to cash. That is the force that pulled the price down from its January peak, and it is real. And it explains the pullback you can see in your own account if you bought near the top. The second force is structural, and it moves on a completely different timeline, measured in years rather than weeks. Central banks around the world have been purchasing gold at a pace not seen in generations, treating it as insurance against exactly the kind of currency and fiscal uncertainty that a headline jobs report does not resolve in either direction. That structural buying has not stopped. It has continued straight through the correction, which is precisely why the banks trimmed their short-term numbers to reflect the mood while leaving their longer-term targets intact to reflect the structural case underneath it. There is a historical pattern one of these banks pointed to directly that is worth understanding on its own, because it explains where a number as large as $6,000 actually comes from, rather than being pulled from thin air. Looking back across gold's past major bull markets, the average total gain across those periods has run in the neighborhood of 300% over roughly 3.5 years from a cycle starting point. That is not a prediction of certainty. It is a historical pattern that analysts use as a reference point when a new bull cycle appears to be underway. And it is part of why a bank like Bank of America felt comfortable setting a target as aggressive as $6,000 even before this year's correction began. History does not repeat exactly, and I will come back to that important caveat. But understanding where these numbers actually originate helps you see they are not simply guesses dressed up as forecasts. Let me make this real with two people, because none of this matters until you see how it lands in an actual life. Neither is real, but both are the kind of person you might recognize. The first I will call Roland 70, who bought a modest position in gold near the January peak. Drawn in by the record high headlines everyone was talking about at the time. When the price pulled back sharply over the following months, he watched the value of his position fall on paper and began reading headlines suggesting the rally was finished. Gold's moment had passed, and the smart move now was to wait for something else entirely. Roland was reacting entirely to the mood, the day-to-day price action, without ever checking what the institutions actually managing serious money were doing with their own published research during the exact same stretch. The second person I will call Faye, 68. And she also bought near the highs, and she also watched the same painful pullback in her own account. But rather than only watching the price, she checked what the major banks were actually saying in their own client research during the correction. And she noticed that even as those banks trimmed their near-term numbers, not one of the major institutions actually abandoned a target well above the current price. She understood that a 45% gap between where 6 major banks say gold is heading and where it trades today does not close, simply because the mood turned sour for a season. Roland sold near the bottom of his own patience. Faye held, not out of blind hope, but because she had actually done the work to see what the most informed money in the room was doing. Not just saying the difference between them was never how much gold either one owned. It was that one of them let the daily price alone tell the whole story, and one of them checked what sat underneath it. Now, why do so many careful, intelligent people end up like Roland reacting entirely to the mood, while missing the structural story sitting right beside it in plain sight? There is a simple, documented reason. A falling number on your own account statement registers in the mind as an immediate personal loss, activating a genuine emotional response that a paragraph of bank research simply cannot compete with in the moment. The pain of watching your own position shrink feels urgent and real in a way that a distant institutional forecast, printed months ago in a document you never read, simply does not. This is not a character flaw. It is how the mind is built to respond to loss. But it is also exactly why the investors who consistently position themselves ahead of these longer cycles are rarely the ones with less emotion. They are the ones who have built the habit of checking the structural research, specifically during the moments when the daily mood feels most convincing in the opposite direction. Now, let me be careful and honest with you, because I will not insult you with fear. And this exact subject draws people who want to frighten or excite you into a rushed decision. A $6,000 target from a major bank is not a guarantee. And every single one of these institutions attaches real conditions to their own forecasts. Continued central bank buying, a genuine Fed shift toward easier policy, and no major surprise on the fiscal or geopolitical front that changes the picture. Some of these same banks have already shown this year that they will cut their numbers if conditions change, and there is no reason to assume they will not do so, again, if the underlying story shifts. Gold remains a genuinely volatile asset capable of disappointing even patient holders for extended stretches. And anyone telling you $6,000 is a certainty, rather than a well-reasoned target, is overselling you confidence that no forecast from any institution actually deserves. What I am giving you is not a promise that gold reaches $6,000 on any particular schedule. It is the actual research 5 major banks have published, sitting well above where the price trades today. So you can weigh it against the daily mood with clear eyes instead of only the number on your own screen. I want to say a word about silver here too, because it belongs directly beside this story rather than as an afterthought. Silver has its own separate structural case, a 6th consecutive year of a genuine supply deficit and heavy industrial demand from solar and electronics that does not depend on any single bank's gold forecast at all. But silver has also historically tracked gold's major moves with real force, often amplifying them in both directions, which means that if the structural case for gold that these banks are describing does play out over the coming years, silver has historically been the metal that moves even further and faster once that broader trend takes hold. So let us pull this together and go back to where we started. Gold trades today below the level that JPMorgan itself describes as its worst case floor, while that same bank, alongside Bank of America, Wells Fargo, Société Générale, and others, maintains published targets of $6,000 an ounce or higher, a gap of roughly 45% between the price on your screen and the number these institutions are telling their own clients to expect. That gap exists because 2 different forces are pulling in different directions on 2 completely different timelines. A short-term mood soured by rate expectations and a long-term structural case built on central bank buying that never actually stopped. History from prior gold bull markets shows why a number this size is not simply invented out of nowhere, and the difference between the people positioned for the structural case and the people who only ever see the daily mood comes down to one habit: actually checking what the institutions with access to more information are doing with their own published research, rather than only watching the number on your own account. Here's what I want you to carry away from this, stated as plainly as I know how. This is not a call to chase a price target or make any dramatic move today, because balance, patience, and clear eyes matter more than any single forecast, especially with retirement money. It is a call to understand that a painful pullback in the mood and a broken structural case are 2 very different things, and that the largest, most informed institutions in the world currently believe this is the first, not the second. Whether a modest, deliberate allocation to gold or silver belongs in your own plan depends entirely on your own circumstances, your own timeline, and your own comfort with the kind of volatility we have all watched play out since January. And I am not here to tell you the number. I am here to make sure you are weighing the daily mood against the actual research these institutions have already published, rather than only one side of that story. Do not let anyone use a number like $6,000 to rush you into a costly decision today, because there will be people trying, and they get louder every time a forecast this large gets attention. And do not dismiss it either. Telling yourself a painful pullback since January means the underlying case has quietly disappeared, because you just watched 5 major banks tell their own clients precisely the opposite in their own published research. Those are 2 different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, each bank's specific price target, the dates of each revision, JPMorgan's stated bear case floor, comes directly from each institution's own published research and reporting on that research. So you can verify every word of it yourself rather than take mine. I opened by telling you that gold trades right now below a level 1 major bank, calls its worst case floor, while 5 major banks maintain targets near or above $6,000. Now you understand exactly why that gap exists. A short-term mood that turned sour, sitting on top of a structural case that never actually broke. So let me leave you with the question underneath all of it. When the daily price on your screen and the research sitting in a bank's own client notes are telling 2 completely different stories, which one do you think actually deserves more of your attention? The one you can see change every single day, or the one the most informed money in the world is quietly still betting on?